It's my absolute pleasure to introduce Lyn Alden. Lyn is the founder of Lyn Alden Investment Strategy and by far one of the most respected and well-known people in finance and Bitcoin. When she writes or speaks, everybody drops what they're doing, at least I do, and listens. Thank you so much, Lyn, for taking the time to share some of your knowledge.
Thanks for having me on your show.
I just want to get started on a bit of your background because I know that a lot of my subscribers aren't really a lot of them aren't in the world of finance or just starting to dip their toes in the world of Bitcoin. So if you could tell us a little bit about your background, what you did before getting involved in Bitcoin and crypto, and what about this technology sort of made you take a deeper dive into it.
So my background is in electrical engineering, and so I worked for about 10 years, or it depends on how you measure it, even like 12 years in some cases. But basically, I worked for quite a while as an electrical engineer, kind of worked up the ranks, became engineering management. So I started doing finance and overseeing the facility more so than doing hands-on engineering. And on the side, I've always been interested in investing. So I've always been looking at different types of stocks. That includes technology stocks, but also includes non-technology stocks, certain commodities, things like that. And so my first contact with Bitcoin was actually back in, it would have been 2010 or 2011, where I had a friend that mined it. It was like back when you could do it with a GPU. It was really early. And so like I spent like an hour or two kind of looking it up, and I thought it was neat, but I had no idea how to price it, and just kind of was like, oh, that's cool. And then, just kind of, went on my way. And then I always like kind of, I would hear about it once in a while. I'd be like, oh, now it's like $100. That's like, wow, it's really doing good. But I just like, I don't know how to, it wasn't like a big market at that time. And so it still wasn't fully on my radar. And then the first time it really kind of came onto my radar as like an investment option was in 2017 when we had that large bull run. And so I actually had around the same time, it was, in my engineering procurement, we were actually having trouble getting graphics cards. And a junior engineer was like, oh, that's because of the Ethereum bubble. I was like, what's an Ethereum bubble? And so yeah, I got like the 101 on what Ethereum is. That was back when it was probably like $200 per ether or something like that. And so, basically we had tangible issues. We had trouble getting graphics cards because of this. And I was like, I better look into this. And so I did kind of an article back then on the space. And at the time, I had a pretty favorable article on the space, but I still kind of didn't know how to price it. And I said, especially because I was covering it in late 2017 after that very large run up, and I was like, it's very euphoric. And so I still passed on it, but I was like, it is, I'm definitely going to keep my eye on it now. And so some of the concerns I had at that time were generally addressed over the next couple of years. You had a price consolidation. We saw some of the outcomes of the different fork wars, or which networks are kind of in the lead. And so when it came time for early 2020, when we had markets around the world crashing and for different reasons back in March, so when I saw them kind of rebounding in April, that's when I bought into Bitcoin. And I've been covering the space a lot, so it's kind of like my first touch with it, I might have put 2 hours into researching it. The second time I looked at it, it might have been 20 hours. And this last time is when I put like hundreds and hundreds and hundreds of hours because I finally got it. Basically, I saw the technology in a way, and I really put the time in to see what's going on.
Amazing. Would you say that touching on your engineering background, would you say that also helped you when you started diving into the more deeper aspects of the technology for you to grasp it a little bit, or was it always more of an investment and looking at it from, say, a macro perspective?
The engineering was certainly helpful, and so I kind of looked at it the first time through an engineering lens. I want to know how it worked, and I was like, that's cool. And I didn't look at every detail about how it works, but I got the general idea, and so I wasn't like confused by how the general idea works. But it was kind of like that intersection of everything together. When it became big enough, I'm like, okay, this is a real thing, and then I looked at it in more technical depth. And so definitely the engineering helped a lot there. Now, my background is not firmly in software. I've written code and I've overseen software coders. So it's like I know enough to know what I don't know, kind of, but like I can poke around and see what's going on. And so overall, That's certainly been a helpful component. And then the other component is the fact that I have experience with precious metals and the idea of hard money, for example, or the history of what has been used as money. And so those kind of that Venn diagram of those two kind of things coming together, I think, was what made me kind of eventually realize that it's actually an investable space.
Interesting. I'd like to touch on a topic that's pretty popular nowadays, and I suppose it'll be continued to be popular. You've written a lot about it, which is inflation. And I was wondering if you could explain how inflation, or what inflation is, how it gets measured, and how you see it playing out over the next couple months and years and decades. Because I know, well, the Fed has come out saying that it's going to be transitory. And I guess there's a lot of voices within Bitcoiners that it's not going to be transitory. So I'd like to hear your opinion on that.
So in general, inflation, there's that quote, it's everywhere a monetary phenomenon. And I think, that has a lot of truth. That might overstate it, but in general, if you look around the world, you see where price inflation has happened, you almost always see that the money supply is going up by quite a bit. And so generally that can happen for a couple of reasons. Either banks can lend it into existence, which is generally the normal process of creating money in a fiat currency system, or the government can run very large deficits and have the central bank basically create new money to buy the bonds associated with those deficits, and therefore they kind of go around the banking system or straight through the banking system, and they just kind of put more money into existence. They spend more into the economy without removing it. And if you do that enough, you can get a really rapid increase in the money supply, and so everybody suddenly has more money to buy things with, but the actual things are still limited. And so you start running into either shortages or the price goes up until you find the actual kind of market price for that. And so you can certainly have periods of transitory inflation where there's a specific thing that is say a supply shortage. Let's say a bunch of copper mines are striking, and so now copper is in short supply. Well, that can happen. That specific commodity can spike in price even if there's no growth in the money supply. That's a specific supply bottleneck, and once it's resolved, we would expect the price of copper to come back down to its more normal level. The same thing happened in lumber in certain places this past year, where timber didn't spike in price, so there's no shortage of felled trees, but there's a shortage in how much capacity in sawmills could turn that timber into lumber. And so when everybody wanted to go build a suburban home at the same time, there's only so much sawmill capacity, and so they ran into a bottleneck. And so generally, there's at a broad prices generally go up due to the money supply increasing at a faster rate than goods and services, whereas you can have those more transitory, one-off type of events. The other thing I would add is that, transitory in rate of change terms is different than transitory in absolute terms. So, prices can go up rapidly and then they can stop going up, but they can still stay at that high level, right? So it's transitory in terms of it's not just continuing to go up and up and up, but it's not like those general prices come back down. That's sometimes what you see, for example, say in the 1940s in the United States, you had these spikes of inflation, and you'd have prices permanently go to a new higher plateau, and then they wouldn't just keep increasing until maybe a couple of years later there'd be another spike and there'd be another higher plateau of prices. So there's a couple ways that inflation can manifest.
And along those lines, would you say, how do you see inflation playing out over the next couple months and years with recent, I guess, money printing, and I guess sort of looking at it from your macro perspective? Do you think it is transitory? Do you think it, and I guess it'll probably tie into the next question, which is a little bit of how you see the dollar's hegemony as a reserve currency, especially in face of these inflationary pressures?
So I generally expect to see pretty sticky inflation, but then the rate of change will depend in part on how much more fiscal spending happens in some of these countries. And so if you look back, say over the past year and a half to the beginning of 2020, say, the United States money supply went up faster than most other advanced nations. Canada was up there as well, whereas towards the bottom you had Japan. In the middle you had China, Europe, and Britain. And so, if you look at those countries, for example, we generally see more inflation in the United States, where we increased our money supply fast. We ran much larger deficits as a percentage of GDP, and so our economy in some ways it came up faster from the pandemic lockdown recession, but we also dealt with more inflation. Whereas if you look at some of these other economies, they might have recovered slower, and they also have less inflation. And so my overall base case is that it's largely going to depend on fiscal decisions, which can vary from country to country, and generally each country has their own bottlenecks, right? So in the United States, we have a tightly divided Senate. In Europe, they combine multiple of their currencies into the euro. So not only do they have in the United States, we have different states arguing with each other, they have different countries arguing with each other. Japan is more unified, so they're able to they have a little bit less polarization. And then of course, different emerging markets will have different their own kind of characteristics that are happening. And so we don't, for example, see a ton of money supply growth out of Russia. We don't see a ton of money supply growth out of China. They're at somewhat more normal levels. And so I think it'll vary around. Now, of course, there's still kind of issues that you can have if your currency is, say, not going up in value a lot, but its exchange rate is still going down temporarily. Like we saw that with Russia, where they did not do a lot of fiscal spending, but their ruble still lost value, especially when oil prices were going down. And so that can still vary. Overall, for the dollar hegemony, my overall kind of base case here is that the world's kind of becoming more multi-currency, multipolar. And so it used to be the case that all energy worldwide was priced in dollars. So no matter what country buys oil from another country, it's always in dollars. And that was because of specific agreements that the United States made with OPEC back in the 70s. And so that's generally been the rule for a long period of time. There have been occasional deviations, but for the most part, that's been structurally happening. But ever since the past several years, you start to see, for example, Russia selling their oil in euros. We see that China is more interested in being able to use their currency to buy some commodities and energy as well. And so we're seeing around the margins that's shifting over time. We're also seeing that if you look at the currencies that different countries have in their reserves, it used to be very, very dollar focused, and it still is. But that percentage that is in dollars or treasuries is gradually declining over time as these countries diversify their reserves a little bit. And then there's some outliers like Russia that pretty much completely de-dollarize, and they focus heavily on the euro. They focus heavily on gold. They focus somewhat on China's currency because that's more of a specific situation. Whereas most countries, they're still very dollar heavy, but it is decreasing over time, which makes sense because in the beginning of this system, the United States was maybe 35% of global GDP. We were the world's biggest energy importer. And so we could kind of get away with making sure everything is priced in dollars. But as over time, as you've seen the rise of China, as you've seen, just overall growth in the world that's faster than the United States on average, especially among emerging markets. The United States' share of global GDP has gone down. Now it's about 20%. We're no longer now we're the second biggest energy importer, and so generally what we're seeing is a little bit more diversification and decentralization. But that is, of course, is a really long kind of slow process.
Yeah, that makes sense. That I suppose that the dollar losing its dominance will obviously take a long time, and it'll play out according to a bunch of different factors. And you touched on something that I think that's linked quite closely to where I live here in Chile, which is a third world country, an emerging market, and sort of to connect it to Bitcoin specifically. Do you see a case, or what would be the case for Bitcoin within emerging markets?
Well, certainly, I mean, one of the advantages of Bitcoin is that it has this pretty long history now of going up over time, and so it can be quite volatile. And so in developed countries, a lot of people don't get why someone would own Bitcoin other than speculation, and it's because they're used to having pretty stable currencies. Whereas emerging markets, some of them are currently going through very bad periods of inflation, and other ones generally still have inflation somewhere in their memory over the past 20 years or so. Whereas the United States, we have to pretty much go back to the 70s to have a memory of strong inflation. And so in a lot of those markets, it's in some ways, I think it's an easier selling point of why they might want to hold something that's not their own government currency. that can't be debased in any sort of reasonable way or easy way. And that they are owning something that's scarce. And then, of course, some countries have capital controls. Bitcoin makes those more difficult to enforce. And so it means different things to different countries. I mean, obviously, in say, Lebanon, right, they have a much worse inflation problem than many other countries. And so that's, it's a more extreme situation. But across the board, I mean, I think it's one of those things where Bitcoin can benefit, people in every country. But I think it just so happens that emerging markets, I think, can get the reasons for it maybe a little bit faster.
Yeah, I would definitely agree, especially looking at our neighbors, Argentina, Venezuela, a bit to the north. It's kind of a lot more in your face, that possibility of rampant inflation, hyperinflation, capital control, and the need for something that, yeah, protects wealth in a pretty, although volatile, but pretty established way already. You've written about network effects, and you touched just now that Bitcoin does have I guess not a very long history, but over the past 12 years, it has inserted itself, and it's inserting itself even more as time goes on. Do you think you could briefly explain what network effects are, and how they're useful when researching not only Bitcoin, but other assets?
Yeah, so network effects are a phenomenon where the more people that use it, the more valuable the network gets exponentially, right? So if only 5 people in the world have phones, a phone is not a very useful invention. But if half the people in the world have phones, then suddenly it's one of the best inventions ever. And so basically, the phone gets exponentially more useful the more people you can call with it. And so the same is true for email. The same is true for social networks, right? You wouldn't want to have a social network with almost no one on it. And so that's generally one of the strongest economic moats that a company or a protocol can have against competition, is the fact that they've already achieved network dominance. And so I could make, for example, I could hire a programmer. We make like a copy of Facebook. It looks similar, but then I'd have almost no chance to get people to actually use my version of Facebook. There'd be no kind of flywheel to get that started, because it's a dead zone anyway. Even if I threw $1 billion at it, I could get probably a couple million people there, but they would quickly just go back to the real major social networks, as an example. And so that's true. Also, I've used the example of Wikipedia. Wikipedia, you can download the data. I could host it on my website, and it would kind of look like Wikipedia, but it wouldn't have the millions of links around the world pointing to it the same way the real Wikipedia does. That's the thing I can't replicate. That's the network effect. And I can't replicate the fact that there's so many users on Wikipedia updating it. I can't convince them to come update mine instead. And so mine will always be this kind of shadow of the real thing. And so my biggest concern when looking at cryptocurrencies, especially back in 2017, was, okay, so it's open source, anyone can make a copy of it. And so the whole idea of scarcity is then challenged if someone can just make Bitcoin 2 or Bitcoin 3 or Ethereum 2. And so I was like, I was concerned that, even if the space takes off, it's neat technology, the capital could go in and just diffuse among like so many different protocols, like basically a permanent alt season where just like everything kind of goes up and down and nothing really kind of accumulates persistent value. But then I kind of just kept studying the space more, and I saw that the network effects apply very strongly to cryptocurrency, and network effects apply to money in general. I mean, part of why the dollar has hegemony, in addition to just the United States military strength, the history of how we got here, is that it's kind of self-sustaining as a network effect. And so, there's dollar-denominated debt around the world, including in Chile. And so that basically that's demand for dollars, right? Because all these countries need dollars in order to service their dollar-denominated debt. And then out of kind of ease, lenders, when they lend more money, they often do it in dollars. They could do it in euros, sometimes they do, but that dollar has the strongest network effect in that space, and that's why generally diversifying away from it is a slow process, right? Because it's so entrenched already. And so with Bitcoin, for example, or cryptocurrencies in general, the fact that the security is tied to is tied to how popular it is generally. So it's much harder to attack. That makes it more desirable to begin with, so more people stick with it. That makes it even more secure. And we also see, for example, that more developers work on the top cryptocurrencies, so they get better hardware wallets, they get better applications, they get better security and upgrades over time. than some of the ones that kind of get left behind. And so we start to see over time that cryptocurrencies start to resemble social networks in the sense that they have these network effects, and you're going to have, most likely just a small number of them rise to the top, and that long tail of thousands of cryptocurrencies, for the most part, don't matter. And so the two that I consider to have really strong network effects this time would be Bitcoin and Ethereum. Whereas the other ones, they might have kind of interesting use cases. They're showing interesting technology, but they still haven't, reached a network effect that is kind of self-sustaining. An example I like to use is, the whole internet runs on TCP/IP, and it could have been, it could have been designed a little bit differently. Someone can make a competing protocol. In fact, there have been competing protocols, but they never catch on because the entire internet's kind of set up to use this one method. And so even if I came along and said, "Hey, I have this method that's like 5% better than TCP/IP," people would say, "Oh, we don't care, because the fact that none of the websites in the world are going to interact with your protocol already makes your protocol a million times worse, even if it's 5% more efficient." And so, if anything, TCP/IP could maybe kind of incorporate some of my ideas, make theirs better, but my protocol would never catch on. And so, generally, basically, in order to disrupt an existing network effect, the up and comer has to be like 10 times better. It has to be like so much better that you eventually just can't not switch. It's clearly superior. And so we see, for example, that these network effects rise to the top, and then the question is, can they sustain them? Can they upgrade enough to make sure that nothing comes along that's, say, 10 times better, and then they kind of remain kind of the kings of the space?
Interesting. Yeah, I have that same discussion at home with WhatsApp and alternatives to WhatsApp. And sort of the conversation usually goes along those lines. It's like, well, everybody uses WhatsApp, so why would I even think about switching? And the network effects are just way too broad and pervasive for it to even question the use of it.
Yeah, really good example. Like we have the delete Facebook movement, right? So hashtag delete Facebook, and yet people are still there. And just because it's they can make their own thing, but they can't reach critical mass. We saw the same thing with Parler. They try to make their own version of Twitter and Facebook. Obviously they ran into some regulatory issues, but it's just kind of a critical mass thing. It's really hard to disrupt one of them. It can happen. It's one of those things that's super challenging.
And would you say that that disruption only comes from a sort of technological point of view, or is there anything else that would kind of tip into sort of that sort of disruption and breaking some assets or network effects?
Usually it's, the examples that I can think of, it's usually technology that allowed a network to a new network to come that's 10 times better than the previous ones. And so there's all sorts of examples where, existing, like I use the example in the United States, we have UPS and FedEx as our major shipping services, and they're both these very large corporations. They have sites all around the country, very, very hard to displace. They're basically a duopoly along with the United States Postal Service, so three main services. And the biggest logistics company in Europe decided they want to break into the North American market, and this was like 10, 15 years ago, and they spent like $10 billion acquiring a couple like the logistics companies and kind of building that out, and they eventually still just couldn't do it. They just couldn't break in enough to get profitable because they just couldn't compete with how many sites and infrastructure those two big ones already had. And so that's an example where unless they came up with some brilliant technology that allows 10 times better packaging, it's really hard to break into that market. And so we see that, for example, with stock exchanges or futures exchanges, where once one of them becomes very entrenched, and that's where most of the liquidity trades, then that kind of futures contract, for example, becomes kind of the benchmark. And even though there might be other ones that come along, they generally have trouble getting anywhere near the same amount of volume and liquidity as that big one in that country. And so it is pretty rare to have a network effect displaced outside of either the government comes in and it does like antitrust activity to kind of purposely break it up if it's something like that, or it's often technology based.
Interesting. Going back into, or I guess staying on Bitcoin, what would you say are your main concerns with the protocol, maybe from a regulatory perspective, from an investor perspective? When I guess it took you a while to even get, it took you 6 years to sort of dive deep. And I suppose that you approached it with a lot of scrutiny and kind of looking at risks, rewards, and everything. So I'd like to know your opinion on what are the main risks that you see associated with it.
I think that the first one is just making sure the network effects are strong, right? And so make sure that there's no other kind of one that would compute Bitcoin, at least in terms of store of value, right? So we have Ethereum competing on smart contracts. It's also dabbling in store of value to some extent. But besides those two big ones, there's kind of a big gap between any of the others. So I watched that space. I watched development that's happening on Bitcoin, on Lightning, some of the surrounding ecosystem, things like that. I want to see continued advancements there. And then really, apart from that, it's mostly a regulatory standpoint. And so we've seen some countries ban it, and then, some of them actually kind of walk their ban back. And so it's kind of a challenging thing where they can't ban Bitcoin, but they can ban themselves from Bitcoin. And then they start realizing maybe this was a bad idea, and then they reverse course. I think that one of the major kind of tail risks would be if, say, the United States and Europe banned it. Because that would be a big enough blow that there's so much of the capital in the space is in the United States and to a lesser extent Europe, that could actually slow adoption down by a meaningful amount. I think, at least for a period of time. And they can't, it'd be very hard for them to say you can't own Bitcoin, it's illegal, we're actually going to make sure you don't own Bitcoin. But what they can do is make it so that banking systems can't send, fiat currency. They basically ban all of the fiat currency on ramps in a similar way that Nigeria did. But for Nigeria, it mainly just affects Nigeria, and they do peer-to-peer trading. Whereas the United States and Europe, if you were to cut those on ramps off, that could seriously slow down market cap accumulation. On the other hand, it's in the United States, for example, we have a lot of guns here, and so whenever there's, say, a big school shooting or there's a president that gets elected that's not very favorable towards guns, a lot of people that like guns go out and buy more guns because they're worried that they might not be able to buy them in the future, or it'll be harder to buy them in the future, and so they go out and they actually have, one of the best things that ever happened for the gun manufacturers was Obama's presidency, because they were concerned that he might want to reduce their ability to buy guns. And so you could see that kind of thing, ironically, with say Bitcoin and some of the other cryptos, where if they get heavily restricted from being owned, you could have actually people go out and buy a lot just to make sure they get them. And so we actually don't know the full game theory for how that would play out. But I do think that basically a ban from the banking system from Europe and the United States is big enough that I would consider that kind of a concern.
And do you think it's plausible to think of a ban from the United States and from Europe, especially thinking that Europe is pretty fragmented in terms of their own banking? Like you have Switzerland that's got one approach. You have, I guess, Portugal that has another. Do you see that ban actually being possible? Or, I mean, I guess everything is possible, but like a real chance?
I think a very low risk. I think it might have happened earlier, but it didn't. And now that it's big enough, for example, that now it has its own lobbying group. In fact, that's actually playing out right now in the United States. They're passing an infrastructure bill, and they kind of snuck in this like way to kind of try to get more taxes out of cryptos. But it's poorly worded because it's written by people that don't fully understand it, and they basically saying that if you assist in like transferring it for another person, you have to like file these crazy tax forms, and that can technically apply to miners, that can apply to Lightning nodes, that can apply to like DeFi, and it's like unenforceable. And people can interpret that as like almost like a mining ban, because you can't operate a miner if you can't enforce. So basically, the lobbying group is trying to say, let's actually clean this language up so we don't inadvertently kind of give this industry kind of a regulatory nightmare to deal with. And so that wasn't possible many years ago when it was a tiny fledgling industry. And so the fact that it's gotten big enough, there's billionaires that own it. There are very large companies that own it. There are senators and representatives that own it. And we see that across the world now, where there's politicians that are say Bitcoiners, or they're into crypto in general. And so I do think that becomes a lower and lower probability now. And I think we've kind of crossed the event horizon. You'd have to have a pretty extreme outcome, especially I think in the United States, just because that goes against a lot of the values of the place. Now, people always reference the fact that in the United States, for example, we had a 40-year ban on Americans owning gold from the 30s to the 70s. It was like literally a criminal offense if you owned a ton of gold. Now, it wasn't very heavily enforced. They didn't go out and just kind of check door to door to make sure no one has gold. But it was kind of like enough of a threat that a lot of people did not own gold. And so, there has been extreme things in history. My overall base case is I think that's a very low probability from any country that really has some degree of freedom and free markets.
Yeah, I think I read today in the morning that the infrastructure bill actually got a bit of a change in the language, and they started adopting a little bit of a friendlier stance towards some of those crypto actors that you were saying, like miners that weren't necessarily brokers or other services. I'd like to gear us into, say, CBDCs, because I know that's still a pretty intense topic. Here in Chile, there's a sort of central banking task force investigating and researching and developing. I'm not sure how far along they are, but I do know that they're looking into it. So I'd like to hear your perspective on how CBDs would look, or stance of central banks towards Bitcoin as well, and towards some of these new crypto assets.
Yeah, so I think they're certainly coming. They're certainly on their way here. I mean, we see Bahamas has one. China's obviously very far along. They're basically in the process of rolling theirs out. And most central banks talk to each other, right? So they have the Bank for International Settlements. They have these organizations where it's not like they're all working on it individually. They have a lot of resources they can share. So once a handful of the countries start to get workable adoptions of it, that can quickly spread to other countries as well. And so they're certainly sharing notes on that. And some countries like China are going to love it because China is rather authoritarian. They like to have a lot of surveillance. They like to have a lot of control. And so a currency that can be heavily monitored, that can be, say, shut off, addresses can be blacklisted. You could have it expire. You could have it be programmed to only be expended in certain areas or for certain categories of goods. And so that's something that they like as policy tools. But it's obviously something that a lot of people that like privacy or like control of their own assets would really prefer not to have, or at least prefer to have it optional to use it, right? That they can use it when they have to, but then they can go and as they store their money in Bitcoin, whatever else they want to do, and not be kind of locked into that system. And so I think that's if we talk about, say, the potential for a Bitcoin ban, I think a rollout of a CBDC is one of those events where you have to be kind of on guard, because they could try to crack down on some of the competitors when they roll that out, especially if there's not a lot of traction for it, if people are kind of pushing back on it and calling it a surveillance coin and things like that, if people kind of catch on in a negative way. And so I do think that's a risk point to watch. And so especially because we've seen literature from the IMF and from a number of central banks where they view CBDCs, they can do things like gradually phase out cash, and then if you're kind of locked into that CBDC system, you can even have negative interest rates more easily. For example, like in Europe, they have mildly negative interest rates in some cases, but some cases they prefer to go even lower, but they know if they go too low, people pull out their money and hold it in cash. But if they phase out cash, that kind of limits their ability to do that. And they can actually charge even deeper negative rates, which is really undesirable for the people holding it. And so I think that's going to be an ongoing drama for a while. I also think we have to watch to see how it works between private stablecoin issuers and governments issuing it. And so basically, like now we have over $100 billion of private stablecoins, and we have companies like Facebook are interested in getting into them. So right now they're heavily used in crypto trading, but they're not really heavily used for payments. Whereas companies like Facebook want to roll them out and actually start using them for domestic and international payments. And I think we could see a few companies get into that space. And it'd be interesting to see if some countries, like let's say the United States, for example, try to use like private companies as extensions of their CBDCs rather than try to have it issued all directly from them. And so I think you could have some countries go the pure government route, and I think you could have other ones where they use some of the private technologies as well. And so I think it's still a very dynamic space. It's up in the air.
Yeah, it'll be interesting to see how it plays out, especially because I remember watching an interview not too long ago of the president of the Bank of International Settlements saying something like they're going to have absolute control over the rules and regulations and how to enforce those rules and regulations. So it's kind of a daunting space, I guess, as to how it might play out.
And he's the head of the Bank for International Settlements that all the central banks basically talk to. And so that kind of idea can spread. It's funny that he said things like that out loud. Basically, there's been a number of research papers that just kind of lay out the things they want to do with central bank digital currencies, and they're generally all the things that savers wouldn't want, but that certain banks or certain governments might want. And so it'd be interesting to see how they spin that. I think when they roll them out, they generally have to roll them out in a way where, like in China, for example, when they did tests with it, they just gave people some of this money in certain cities, and so the incentive was you get free money. And so it's kind of like, in order to get people to use it, it's kind of like you have to generally start by saying, hey, if you want this free $500, you have to sign up for our digital wallet, and you can only get it in this form. And so it kind of has to come with a gift, essentially.
Yeah, exactly. Otherwise, it would be kind of hard to sort of convince people just out of the bat to use those systems. What would be, given that Bitcoiners are pretty anti-fiat, what's your position on fiat currencies, even holding them for, say, retail investors, of people thinking of including fiat or cash in their portfolios, maybe from sort of a macro investment strategy?
So it obviously varies a little bit depending on what country if someone lives in, what their inflation rate is, what their interest rates are, what their country's debt situation is like, that basically how well they're managing the currency, the growth of the money supply. But overall, I think a general trend we're going to see over this next decade is that many fiat currencies will devalue compared to hard assets, and so their interest rates will not be keeping up with inflation. And so that's a kind of a broad trend that I'm seeing. I mean, even in say the 2010s decade, if you look at, say, U.S. Treasury bills, they actually failed to keep up with inflation through most of the decade. And even though inflation is pretty low, if inflation's like, say, 1.5%, and T-bills spend most of their time yielding less than 0.5%, that means they gradually kind of lost purchasing power for most of the decade. And so I think that's accelerating a little bit here in the 2020s. And then if you look back in history, there were periods of time all throughout the world, different places where you have these notable currency devaluations. And basically, we have so many countries have so much debt that they can't realistically pay positive real yields on that debt without it kind of ballooning out of control. And so one of the tools they have is to basically just make sure that they're paying negative real yields. And it could be in some cases outright negative yields, or it could just be that they're slightly positive or zero, but that they're below the inflation rate for a long period of time, and so bondholders get devalued. And so overall, I'm not a huge fan of holding fiat currencies in most countries. Now, there could be periods where you want some, like let's say you have a clear bubble forming in other assets. You might want to rebalance into some cash so that if you do get pullbacks, that would basically reduce volatility. You could get back into those other assets. But I like to sometimes say that, ironically, the only speculative asset I own is fiat currency and bonds, because it's the only asset I own that I don't think has inherent value, and that I don't think will be higher 5 to 10 years from now. Whereas every other asset I own, I try to buy high quality things that I think will be more valuable, either because they're hard money, say gold or Bitcoin, or because it's a stock or something else that I think is going to grow over time. And so some of those I could be wrong about, but essentially by having a diverse set of these real assets, those are like what I've really kind of treating as money. Whereas fiat currency is this thing I buy sometimes because I think it might go up in price, meaning that the other things briefly go down in price, and I can kind of rebalance into that. So it's kind of by having negative real yields, we kind of flip things on our head of what it means to have savings, or what it means to have a defensive real asset.
Yeah, fiat, I guess, serves the purpose at the end of a sort of buy the dip tool, so that when hard assets, do fall, fiat serves the purpose of buying them. Just to finish up, because we're reaching the end of the interview, I and I guess this might be a little bit of speculation, but I'd like to hear your opinion on Bitcoin becoming, say, reserve currency, not necessarily of the world, but becoming a reserve currency of certain countries, and of becoming, say, you mentioned that you have a strong grasp on gold and precious metals, perhaps, displacing gold in a lot of reserve treasuries, or as the giant market that it is. Where do you see Bitcoin over the next coming years and decades?
So we're starting to see, if you do polls of investors in certain countries, I haven't seen it for the whole world, but I've seen it in individual markets. You're starting to see the fact that as many or more people own cryptos than own gold, and that skews younger. I mean, obviously, if you're in your 30s or 40s or 20s, you're more likely to have that be the case than if you're in your 50s, 60s, or 70s. And so generally, we are seeing an adoption of it as kind of a monetary asset. And so there's some countries like Singapore that's pretty high, and whereas other countries are pretty low. But in countries where it has meaningful adoption, it's starting to get higher than gold in many cases. Now, so far, we don't see that among central banks. They're still buying gold. That's their asset of choice. And that makes sense because even Bitcoin, as big as it is, it peaked at like 1.2 trillion this year so far. Now it's back below a trillion. Ethereum is a few hundred billion. And so, when these markets, and they're very volatile. So when these central banks are looking at it, imagine from their perspective the disaster where if they buy Bitcoin and then it's fluctuating around, and then a tail risk happens and it doesn't work out, and then they're like, why did you buy like digits on a computer? What were you thinking? So with like $1 billion, like, so they basically, it's not big enough that they can really kind of put meaningful amounts of funds into it. Now, I do think that if over time Bitcoin continues to grow, and kind of has say another kind of cycle of adoption, another big bull market, it becomes a multi-trillion-dollar asset class. If you have that network effect continue to take off, or maybe over 500 million people in the world own it, maybe 1 billion people in the world own it, then it starts to get big enough and maybe a little bit less volatile, and central banks can then start, potentially using it as a reserve asset. I don't think they're going to just dump all their gold and just pour into Bitcoin, but they can, especially some of the smaller countries might start saying, hey, we want to have a non-zero allocation to this other type of asset. And especially because not only can they store it as an asset like gold, but they can also use it if they need to as a permissionless payment. They can go around all these international finance channels if they're sanctioned or if other things happen, and they can actually just make payments. And so you actually see, for example, maybe countries like Iran have dabbled in that to some extent, because it does offer that kind of technology basis for them. And people might think that's good or bad, but that's just Bitcoin is. And so you could start to see countries maybe hold a little bit of it. But I think overall, it's one of those things where it generally has to get a little bit bigger before most central banks would even really kind of consider it. We see, interesting news out of El Salvador, right? So it's legal tender, and so they're going to have some in their fund, and so that is pretty interesting there. That's kind of a certainly not something I expect to happen in 2021, and so that's actually pretty interesting. And so maybe it's one of those things where I'm saying I don't think a major central bank's going to hold it in the next 2 years, but who knows? If it gets big enough, you can start to get surprises like that.
Yeah, and I think that El Salvador will be a pretty interesting, I guess, experiment, an example for the rest of, or for emerging markets, small countries like Chile, and neighboring countries in Central America, to see how that plays out and where that takes us. Lyn, thank you so much. This has been enlightening and so interesting, and I really appreciate you taking the time.
I was happy to be here, and hopefully it was helpful to your audience.
Surely was. All right, take care. Thank you very much.
Bye.